Today, we're going to do what we do for clients on a regular basis when we receive a portfolio from another firm. We break it down and do an analysis and compare megabank to aligned. Today, I'm going to be representing megabank, and Greg is going to be representing aligned. To start with, we'll look at equities. Typically, in a typical $50 million portfolio, we will see from a wirehouse, they'll have one direct index like buys that they typically charge 20 basis points for. And then they'll typically have 4 other active managers. And you know how we feel about active management. It doesn't work after tax and it underperforms chronically. Those typically cost 28 basis points. And we assume that the manager is charging 0.4% advisory fee. And the tax drag on that portfolio, because it is mostly active management, is typically about 0.5% a year. So the all-in cost for the megabank equity portfolio is going to be 0.65 weighted average fee plus 0.5% tax drag. Greg?
Yeah, so as you know, here at Align, we just use Apply's Global Direct Index. So we keep it really simple. So between our fee, which we're assuming here is 40 basis points, plus the fee for buys, which is only 15 basis points, that's at 55 basis points. And the tax drag, it's quite efficient. There's some tax drag from dividends. We're not even giving any credit for the direct index kind of generating tax losses, but we're assuming, there's a 20 basis point tax drag from the Align equity portfolio.
That's a big difference right there. The other difference is at megabank, you have 5 or 6 accounts that are not tax managed together. So the second thing is bonds. How do they do bonds? And we assume in megabank, you have a 30 basis point muni ladder, and then you have an active mutual fund like we do, and that your all-in costs on the bond portfolio with the manager, the advisor fee being 40 basis points, is going to be roughly weighted at 1%. And the tax drag is pretty light there because a lot of it's municipals. It's only 0.2%. So 1% management fee, 0.2% tax drag on the bonds.
And that Align, we have a similar portfolio. So the difference here is not going to be as drastic. We're going to have our tax-free ladder. We can do that for 10 basis points. And, add the 40 basis points fee, that's 50 basis points. And similarly, there's not much tax drag there. We're assuming 5 basis points. And then we do also pay active bond managers because, as we say, active management works in bonds. So there we're paying about total of 1.2%, 78 basis points for the manager, and then 40 basis points for us. And there's a little greater tax drag there. We're assuming 25 basis points. So all in, that gets us to a 90 basis point, weighted all-in fee, and a 10 basis point tax rate.
Alternatives are probably where you see the starkest contrast. And that's because at a bank, they're often actually not under the advisory fee of 0.4%. They're actually sold in a brokerage account, meaning that there's some conflict there and there's commissions. So typically what we see are structured notes. And so in this assumption, we're assuming $4 million is in structured notes. Structured notes have really, really high cost. Those range from 3 to 6% internal cost. A lot of that is commission paid to the advisor. So we pick sort of the middle ground there, but they're extremely tax inefficient because you got to sell them every 18 months. So the tax drag is almost 2% over time. So they're very, very tax inefficient. Hedge funds are usually a big part of these portfolios. Those are also extremely expensive. Hedge funds are not tax efficient. They chronically underperform. The fees on the hedge funds are enormous. With these funds, you pay upfront fees, you pay administrative fees on top of the 2 and 20 structure internally. And the costs average about 4.5% after tax. There's another 1.5% fee drag. So it's really tough after tax. Drawdown PE funds. So these are like typical private equity funds where you make a commitment and you have a drawdown. These funds have placement fees on upfront. You're typically paying 2 and 20 to the manager. And then to the financial advisor, there's a feeder fund fee. And for a $4 million portfolio, you're going to be paying roughly 100 basis points, 1%. On the committed amount. So if you committed $4 million, you're paying that. That's really mostly going to the advisor, and a little bit of it's maybe 25% is going for the administrative cost of that. After tax, that's more tax efficient. It's only a 0.5% drag, but the costs there are literally as high as 5% in these feeder funds that you're buying from these firms. So it's an expensive portfolio.
It's a much bigger role here as megabank because, as you know, we keep things pretty simple and aligned. We don't use structured notes. We don't use hedge funds. So the majority of what we're using here are evergreen, private equity funds. And here, fees are lower. So it's 1.25% management fee. for the advisor, and then the 40 basis points for us. And then there is a 12.5% carry on top of that. And, the tax drag for those are more minimal. We're estimating 40 basis points. We do some drawdown private equity funds, but those are really limited to the venture funds. And those will be higher. There we're assuming an all-in management fee at 2.65%, and then there's a 20% carry. So all in, if you added, those together, we're looking at around a 2%, weighted fee all in, and then 40 to 50 basis points on the tax drag. So what does it all mean?
Yeah, it means that's half the fee of what you're paying at the other firm and more tax efficient. So let's break it down by asset class. So just to kind of review that, equities at megabank, 0.65% management fee, typically weighted, 0.5% tax drag. For aligned, it's 0.55 and 0.2. For bonds, 1% and 0.2 at megabank, and 0.9 and 0.10 at aligned. And alternatives are 5% typically at megabank, and 1 to 1.5% fee drag versus 1.8 and 2.2 kind of range with us. And the tax drag is 0.4 to 0.5. So very material difference in fees.
We put together to try to understand what does this mean in dollar terms. So, we ran through on a $50 million portfolio, what's the difference in dollars at the end of a 10-year period? And it's pretty meaningful. We would say your $25 million, assuming it's 7% return in the equities, gets you to $44 million at a megabank. At a line, you're talking almost $46 million. So there's a $1.7 million delta there. The bonds, you're $15 million, earning 5%, we assume. There, it's a pretty modest difference. You're 21.8 at megabank versus 22.2 at a line, so 400,000. And as Pat said, the alternatives is where you get a really big difference. We assumed the 10 million grows at 11% at the megabank after taxes and fee drags. You've gotten to about 16 million, where at a line you're at 22.7. So you have an almost $7 million delta there. And what that does, it takes your 50 million at the megabank to 81.8 million after 10 years, and aligned is 90.8 million. So you have almost a $9 million delta over 10 years.
Yeah, and that understates, the reality is that active products, which most of, the structured notes, hedge funds, and a lot of the equities at the megabank were active. And active products underperform benchmarks chronically. Only 7% outperform before fees. So in reality, it's probably worse than that because you're going to underperform passive. So you really have to pay attention to these structural inefficiencies because they really matter and they compound over time. And you need your advisor to be looking for what is the most tax efficient way, what is the lowest fee way to approach every single asset class, because it really does matter over time. Very few people outperform.
And then these are things that are knowable. And this is the math. And the math is that the fees and the taxes are a material headwind. And so, we actually think that we're putting our clients into things that are going to also outperform. But clearly, on the face of it, these fees are a much lower drag here at Aligned.
Yeah, I think another way of saying it is we hope our allocation is the best and it does the best, right? But we don't know that. But we do know what the taxes and the fees and the structure of the accounts are. And if we can manage that well, and we go through a period of time where returns are mediocre, we're still going to do better than that other portfolio. And look, $9 million, over 10 years, that's a lot of money. And just express that if we started with 10 million, the ratios are all the same. But it's really quite meaningful. It really does matter. And with AI, people are going to see the truth. And they're going to change advisors because they're going to realize, hey, you know what? I need to take advantage of modern technology. I want to work in a no conflict environment because you can't.
Well, thanks for taking the time and letting us walk you through these numbers. We think it's pretty powerful and appreciate you listening.
Please send us over your portfolio. We will take a good look at it. We'll doge it.